Good morning, class. Welcome to this session of Strategic Financial Management. In our today's class, let us begin with the new chapter, that is chapter 7 of your syllabus, Venture Capital Funds. Now, speaking about venture capital, it is a new form of um, a financial device that has emerged in the recent years. Now, you might have heard regarding venture capital, and it is also there in your entrepreneurship and new business enterprise. But what I suggest is that since you have this particular chapter in both the subject, you go through with strategic financial management because some of the terms that are being here is not being used in the normal day-to-day life. So if at all you study for your strategic financial management, it would be helpful for your entrepreneurship paper also. Now, speaking about venture capital, um, it plays a very strategic role in financing, especially the small scale enterprise and also high technology and risky ventures. The venture capital activity, if we see, it is bit advanced in the developed countries. Now it has also taken root in a number of developing countries in the past decade. Now this venture capital has potential to become a very important source for financing of small scale enterprises, or what we call as SSEs. So if that is so, what is venture capital then? How does it differ from traditional financing? Now, what are its potential benefits? Now, what is the status of venture capital in India? Now, these are some of the questions that may arise when we try to understand what is venture capital. So, by the end of this chapter, I hope we would be in a situation wherein we can answer all these questions that has been raised. Now, to tell in brief, this venture capital or the capital investments is usually made by either the private investors or the investment firms. Now they focus on giving new business the money they need to grow rapidly. Now speaking about that, of course these venture capitalists expect a profit from their investment. Now they look carefully for companies with a potential of major growth so that they can realize a profit during their exit or when they sell the company. Now, most venture capital investments are made in exchange for shares in the company. Now, venture capital can be an option for certain small business, although there might be that all companies will not be good to fit in for venture capital. Now, moving forward towards the meaning of venture capital, now startup or growth equity capital or loan capital provided by a private investor. Here, a private investor means the venture capitalist or specialized financial institution. that is to tell development finance houses or venture capital firms, also called as risk capital. Now, this venture capital is a type of funding for a new or growing business. It usually comes from venture capital firms that specialize in building high risk financial portfolios. Now, with venture capital, the venture capital firm gives funding to the startup company in exchange for equity in the startup. Now, this must commonly found in high growth technology industries like maybe the biotech industry and software industry. Now, speaking about the origin of venture capital, during the 1920s and 1930s, the wealthy families and individual wealthy investors provided the startup money for companies that later or that now has become famous. Now, Eastern Airlines and Xerox, for that matter, are more famous ventures which are being financed by such people. Now, speaking about this venture capital, among the early venture capital funds set up was the one by the Rockefeller family, which started a special fund called as Venrock during 1950s to finance new technology companies. And there was a professor called as General Doriot at Harvard Business School. In 1946, he set up the American Research and Development Corporation, or what we call as ARD, and it was the first firm as opposed to a private individual. Now, ARD's approach was a classic venture capital in the sense that it used only equity to do investment under venture capital. And they invested for long time period and was prepared to live even among the losers or the companies which made loss. Now, ARD's investment in Digital Equipment Corporation in 1957 was a watershed in the history of venture capital financing. Now, while in its early years venture capital may have been associated with high technology, but over the years the concept has undergone a change and it stands today, which implies pooled investment in unlisted companies. Now, speaking about venture capitals in India. Now, this activity in the past was possibly done by the developed financial institutions of India like IDBI, that is Indian Development Bank of India, ICICI, and SFCs or state financial corporations. Now, these institutions promoted entities in the private sector with debt as an instrument for funding. For a long time, the funds raised from public were used as a source of venture capital. Now, this source, however, depended a lot on the market aspects, and with the minimum paid up capital requirements being raised for listing at the stock exchanges, it became difficult for smaller firms with viable profits or viable projects to raise funds from public. And thereby in India, the need for venture capital was recognized in the seventh five-year plan and long-term fiscal policy of Government of India. During the year 1973, a committee was formed on development of small and medium enterprise, and that particular committee highlighted the need to foster venture capital as a source of funding new enterprise and technology. Now, this venture capital financing started in India in 1988 with the formation of Technology Development and Information Company of India Limited, or it is also being called as TDICI, and it was promoted by ICICI and UTI, or Unit Trust of India. Now, the first private venture capital was sponsored by Credit Capital Finance Corporation, or CFC, and and also promoted by Bank of India, Asian Development Bank, and the Commonwealth Development Corporation through Credit Capital Venture Fund. And at the same time, Gujarat Venture Finance Limited and APIDC Venture Capital Limited were started by state-level financial institutions of the respective states. The sources of these funds were the financial institutions, foreign institutional investors, or pension funds, and even high net worth individuals. Now, though an attempt was also made to raise funds from the public and fund the new venture, the venture capitalists had hardly any impact on the economic scenario for the next 8 years. Now, having given the brief introduction to venture capital, it becomes necessary to understand the notion of venture capital. That is to tell, venture capital, or what we call as VC, is a significant financial innovation of the 20th century. Now, it is generally considered as a synonym of risky capital. That word risky capital itself tells that the Now, venture capital finance is often thought of as the early stage financing of new and young enterprises who are seeking to go or who are seeking to grow rapidly. Now, it usually implies an involvement by the venture capitals or the venture capitalists in the management of the client enterprises. Now, it has also come to be associated with the financing of high-end new technology-based enterprises. The conventional financiers generally support what technologies have been proven in the market and which has established markets, unless like the venture capitalists. Now, venture capital focuses on high technology, but it is not a necessary condition for venture financing. Now, to explain what venture capital is, there is a person who has given a very specific definition. His name is Pratt, and according to him, there is a popular misconception that high technology is the principal driving force behind the investment decision of a venture capitalist. Only a small minority of venture capital investments are in new concepts of technology where potential technical problems and a significant amount of risk to the new business development. But this, however, no doubt that young high-tech companies would look forward to the venture capitalists for making a risky capital available to them. That is to tell, in broad terms, venture capital is the investment of long-term equity finance where the venture capitalist earn his return primarily in the form of capital gains. Now, the underlying assumption is that the entrepreneur and the venture capitalist would act together in the interest of the enterprise as partners. Now, the true venture capital finance any kind of risky ideas. In fact, venture capital can prove to be a powerful mechanism to institutionalize innovative entrepreneurship. Now, this venture capital is a commitment of capital for the formation and setting up of small scale enterprises specializing in new ideas or new technologies. The venture capitalist focuses on growth. Now, he would like to see small business growing towards a large enterprise. Now, having said this, it becomes important that we understand and discuss some of the features of venture capital financing. The first one being equity participation. That is to tell, venture financing is actual or potential equity participation through direct purchase of shares, options, or convertible securities. Now, the objective of a venture capitalist is to make capital gains by selling of the investment once the enterprise becomes profitable. Now, they would make the capital gains by disinvesting themselves from what they had earlier invested. That is to tell, in very simple words, what happens under venture capital is that there would be people who are called as venture capitalists. Now, these are the ones who would invest in the different companies. Now, usually these would be such companies in which the risk of investment would be high, and also on the other hand the traditional financing institutions would not be very much interested in investing because they will have to make sure the money is secured. But the venture capitalists, if they find that even though the investment being risky, there is potentiality for growth in coming years, they would start investing in such risk institutions. And once after the business starts earning money and the investors make the profit or after certain fixed time, they will exit from those particular institutions. And the entry is usually made through equity or by buying the equity shares of such companies. Now, the next one is long term investment. Now, venture financing is a long term and also a illiquid investment. Now, it is not repayable on demand but only after the expiration of time. Now, it requires long term investment attitude that necessitates the venture capital firms to wait for a long period. Say for a year, the long period, the minimum of long period itself would be 5 years to 10 years. But then by the end of the time period, they would have earned huge profits. Now, moving forward, the next one is participation in management. Now, this goes without telling that when you are participating in equity, definitely there is some kind of participation in management. Now, this venture financing ensures continuing participation of venture capitalists in the management of the entrepreneur's business. Now, this hands on management approach helps him to protect and enhance his investment by actively involving and supporting the entrepreneur. Of more than finance, venture capitalist gives his marketing, technology, planning, and also management skills to new firm. Now, this venture capital also provides value addition by managerial support, monitoring, and follow up assistance. Now, it monitors physical and financial progress as well as market development initiative. Now, it helps by identifying key resource persons. Now, these people, they want to be on the company's board of directors and involvement for better or worse. And they are also present in major decisions affecting the directions of the company. Now, this is a unique philosophy of hands on management where venture capitalists acts as complementary to entrepreneurs. Now, based upon the experience with other companies, a venture capitalist advises the promoters on things like project planning, monitoring of the enterprise, financial arrangement, including working capital, and also even during public issues. But then, one thing that has to be noted is that venture capital investor can never interfere in day to day management of the enterprise, but he will always keep close contact with the partners or entrepreneurs to protect his or her investment. The next feature is high risk. Now, by definition, the venture capital financing is highly risk and chances of failure are high as it provides long term startup capital to high risk which high reward ventures. Now, this venture capital usually assumes four types of risk. First one is management risk. Now, it means the inability of the management teams to work together. The next risk is market risk. That is, sometimes the product or the goods or the services that has been provided might fail in the market. Now the next one is product risk. That is, now this product which though may have produced, they might not they, they may not be commercially viable. ఎంత హలో సరే ಹಲೋ ಹೌದು ಹೇಳಿ ಸರ್. ಹಾಂ ನನ್ನ ಅಕ್ಕನ ಹತ್ರ ಕೊಡಿ, ಅವರಿದ್ದಾರಲ್ಲ ಅವ್ರು ನನ್ನ ಅಕ್ಕ, ಅವ್ರ ಹತ್ರ ಕೊಡ್ಬೋದು. ಕೊಟ್ಟರೆ ನಂಗೆ ತುಂಬ ಹೆಲ್ಪ್ ಆಗುತ್ತೆ. ಹಾಂ 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 ಸರಿ ಸರ್, ಅವ್ರ ಹತ್ರ ಕೊಡಿ. ಅದು ನನ್ನ ಅಕ್ಕ. ಆಯಿತಾ? ಆಯಿತು. ಓಕೆ ಓಕೆ, ಥ್ಯಾಂಕ್ ಯು ಅಕ್ಕ. ನಾನು ಕ್ಲಾಸ್ ಮಾಡ್ತಾ ಇದ್ದೀನಿ, ಮತ್ತೆ 12 o'clock ಫೋನ್ ಮಾಡ್ತೀನಿ. ಹಾಂ ಹಾಂ ಇಲ್ಲ, 12 ಗಂಟೆಗೆ. Now, the next risk is that operational risk. Now, operations may not be cost effective, but it results in increased cost and decreased gross margins. Now, the next feature is that high technology. Now, speaking about this, as opportunities in the low technology area tend to be few and of lower order, and high tech projects generally offer higher returns than projects in more traditional areas. Now, venture capital investments are made in high technology areas using new technology. Not just high technology, any high risk ventures where the entrepreneurs has conviction but little capital gets venture finance. Now, this venture capital is available for expansion of existing business or diversification to a high risk area, and thereby the technology financing had never been primary objective but incidental to venture capital. The next feature of venture capital is capital gains. Now, the investments are generally in equity or sometimes quasi-equity participation through direct purchase of shares, options, and convertible debentures. Now, where the debt holder has the option to convert the loan instrument to stock of the borrower or a debt with warrants to equity investment. Now, the funds in the form of equity help to raise term loans that are cheaper sources of funds in the early stage of business because dividends can be delayed. Now, equity investment implies that investors bear the risk of ventures and would earn a return commensurate with the success in the form of capital gains. The next one is length of investment. Now, venture capitalists help companies to grow, but they eventually, or in other words, slowly, or after a time period of 5 to 10 years, they seek to exist from the investment. Now, an early stage investment might take 7 to 10 years to mature, while most of the later stage investment take few lesser years. Now, the process of having significant return takes several years and calls on the capacity and the talent of the venture capitalists and entrepreneurs to reach fruition, or what we call as to earn gains. Now, the next one is liquid investment. Now, venture capital investments are always illiquid. That is to tell, it would be in such a form that if at all you want cash suddenly, you will be unable to use it. And it is not subject to repayment on demand or following a repayment schedule. Now, the investors seek a return ultimately by means of capital gains when the investment is sold at market place. Now, the investment is realized only on enlistment of security, or it is lost if enterprise is liquidate for unsuccessful working. That is to tell, first of all, it is illiquid. Second of all, if the invested capital is on such a venture which might become unsuccessful, then the investor who has invested is going to lose his money entirely, and he will be able to do nothing about that. And that is why, by the mere definition, a venture capital is regarded as the most risky capital. Now, it may take several years before the first investment starts to return proceeds. In some cases, the investment might be locked for 7 to 10 years. The venture capitalist understands this illiquidity and factors in his investment decision. Now, the venture capitalist management approach differs significantly from that of an conventional banker or a lender. Now, the banker does not directly get involved in the operation or the management of the company. Usually these traditional bankers, they play safe, they keep off management and remain passive and insist on security or collateral. Of course, when the banker's stake is very high, he may get his nominees appointed on the board of the company to safeguard his interest also. But whereas the venture capital is also not exactly like the stock market investor who merely trades in the shares of a company without any relations or without any knowledge of its management. In fact, the venture capitalist combines the quality of the banker, the stock market investor, and also the entrepreneur in one term, that is venture capitalist. Now, speaking about this, in India, the Securities Exchange Board of India, or what we call as SEBI, now it guidelines and governs the operations of venture capital funds. Now, venture capital fund may be structured as a company or trust to raise finance through loans, donations, issues of security, or units, and to make investment in new ventures in accordance with the SEBI regulations. Now, by the explanation, we know that venture capitalist is such a capital wherein a person or institutions which has huge amount at its disposal tend to invest in such firms wherein which they can earn more return though it has more risk. But how do they do investment? In what forms does or they can do investment? Now, a prerequisite for development of an active venture capital industry is the availability of variety of financial instruments which cater to the different risk return needs of investors. Now, they should be acceptable to entrepreneurs as well. Now, in developed countries, innovation of financial instruments is a distinct feature of venture capital. Now, venture finance, conceptually being risk finance, should be available in the form of either equity or quasi-equity. Now, speaking about quasi-equity, it means a conditional equity or a convertible loan. Now, a straight or conventional loan involving fixed payments would be an unsuitable form of providing assistance to a new risky venture. Now, these new ventures usually have the problem of cash flows in the initial years of their development, hence, they are not available to service debt. However, the requirement for this kind of assistance can still arise in a few cases, particularly during the second stage of financing after the venture has taken off. Now, venture capital financing in India in the past has taken basically three forms, that is equity, conditional loans, and income notes. But along with that, there are participating debentures, convertible loans, and also few other methods how we can venture the financing of a industry. Now, first among that is equity financing. Now, what happens here is that a firm needs funds for a longer period to survive and grow. But as venture capital firm is a new company, the firm is and will not be able to give timely returns to its investors, for which equity financing proves beneficial. The investor's contribution is not more than 49% of the total stake, and so the ultimate power will always remain in the hands of entrepreneur. Now, since there is a great uncertainty about the generation of cash inflows in the initial years, equity finance is considered to be the safest mode of financing. But a debt instrument, on the other hand, requires periodical servicing of debt. Now, when a venture capitalist contributes equity capital, he definitely acquires the status of an owner and becomes entitled to a share in the firm's profit as much as he is liable for losses also. Now, venture capital funds usually buys share of an enterprise with an intention so that ultimately they should be able to sell off it. And when they sell, they should be sure that they are making some kind of capital gains. The advantage of the equity financing for companies seeking venture finance is that it does not have the burden of serving the capital, as dividends will not be paid if the company has not earned any kind of cash flows. Now, speaking about this, the advantage to the venture capital fund is that it can share in the high value of the venture and make capital gains if the venture succeeds. But the flip side is that venture capital fund will lose if the venture, if at all, becomes unsuccessful. Therefore, at every point that we speak of venture capital, we should always remember that venture financing is always a risky business without any doubt. Now, speaking about the next one, it is conditional loans. Now, speaking about this, conditional loans are the ones that does not carry interest and are repayable to the lender in the form of a royalty after the venture capital undertaking is able to make revenue. Now, the royalty rate may vary from 2% to 15% on the basis of factors such as gestation period, external risk, and cash flow patterns. Now, the actual rate will always depend upon the factors of the venture, like as we discussed, cash flow patterns, risk, and other factors of enterprise. But under conditional loans, it is a loan where you do not have a interest or a fixed rate of interest that you will have to pay. But then what happens is that under conditional loan, once after the company starts making profit, then they will have to give royalty for the venture capitalist. Now, the rate of royalty depends upon 2% to 15% and depends upon many factors of the institution itself, like maybe what is the gestation period that is necessary, what is the risk involved, and etc. From a venture capitalist point of view, equity is an unsecured instrument and hence a less preferable option than a secured debt instrument. But whereas a conditional loan usually involves either no interest at all or a coupon payment at nominal rate. In addition, a royalty at agreed rates is payable to the lender on the sales turnover. As the units picks up in sales level, the interest rate is increased and royalty amount are decreased. Now, some venture capital funds give a choice to the enterprise of paying a high rate of interest, which can be more than 20%, but then they will not be giving royalty on sales once it becomes commercially sound. Some funds recover only half of the loan if at all the venture fails, because they would usually have the coupon rate, but they would not get any royalty because sales would be zero. And these are the two methods of venture capital financing. There are still some other modes of venture capital financing, that we shall discuss in our next class. I would be sending you the link. As soon as you get the link, start joining the class so that we can finish off as soon as possible. Now leave the class, this particular meeting. I will send you one more link. With that link, start joining the